In this video, we're going to talk about the hedge fund strategy of merger arbitrage. Stay tuned. Hey traders, a very warm welcome to you. Okay, so hedge fund trading strategies. Hedge funds will implement specific strategies and bolt them into each individual fund that they have, or if they're a hedge fund with one fund, they will decide on one strategy. And one of the things they do is called merger arbitrage. Now, a little disclaimer here, guys, I work for a hedge fund. So if any of you are watching this work for a fund, or you have worked for a fund and you want to add some more info to this video, then comment section below. Always interested to hear about your experiences too. Okay, so merger arbitrage, the way that I understand it is you have, and actually the way that I've seen it, you've seen it if you're trading stocks, you'll have seen this plenty of times. Let's say we've got a company called John's Metals. Now, John's Metals is trading at £20 per share on the London Stock Exchange, New York Stock Exchange, whatever. Obviously, it'd be dollars if it was New York Stock Exchange, but he's trading at £20 per share. All of a sudden, Bill's Metals comes out and says, I've got an intention to buy John's Metals for £30 per share. So what happens to Bill's Metals? What happens to John's Metals, should I say? We're looking, just focusing on this guy's stock price for this example. All of a sudden, the next day, the price is going to open up at something like £27. And you think, well, why is it not opening at £30 if this guy's offering £30 per share and it's a cash offer and there's no kind of, other little bits and pieces into it, which often do happen. But let's just take it really simple for now. He's going to offer £30 per share, and that will be worked out on the total value, etc., etc., etc. You get the point. Opens up at £27. Why is that? Because there is a chance that the deal won't go through. And that is why this is trading at a discount. Very, very occasionally, you will get a situation where it will open up at, say, £32 per share. Now, why would that be? If we think that it opens up at £27 a share, and that's the reason it opens that is because the market is discounting a potential for the deal not to go through, and that's that slight little discount, that 10% off the 30. They're saying, well, there's a chance it won't go through, so that's the kind of approximate price that buyers and sellers are giving it. Now, just digressing slightly, very occasionally you will open up at 32. Why do you think that will be the case? Because the market believes that this bid of £30 per share will be refused by shareholders of John's Metals, and Bill's Metals will come back with a higher offer of whatever, £35 a share, £36, 30, whatever it may be, a higher offer, or another company might come in and bid for it. So, this is a strategy where the hedge fund has to really know what's going on in the company, really know, with the management team, the shareholders, really know who's bidding for it, why that is, and this is the sort of thing that can happen. Now, you've got to be pretty confident if you're paying more than 32 that that's going to be refused and they have got the money and are prepared to pay more. You've got to actually understand the company and the sector and the profitability. You might say, well, actually, it's well undervalued because this, and this, and this. And again, it's the understanding and knowledge behind what's going on in the business that allows you that kind of insight into it and that kind of ability to be able to take some risks. So anyway, let's look at the standard example of it opening at £27. So merger arbitrage guys will buy this at £27 if they believe that the discount is too much. So if they believe the deal is almost certain to go through, let's say it's whatever calculation they've done or however they've come up with this figure, they say, you know what, it's a 98% chance of this going through. The shareholders here are going to take it for whatever reason. These guys have got the money to do it. It suits the business for them to bolt into that. It's all fits very, very nicely. No regulators are going to say no. Yes, there's no reason why it's not going to go through. We believe that £27 is too much of a discount, so we'll buy a bunch of shares at £27 and we'll wait. And if the deal goes through, we're going to make £3 per share on a holding. If the deal doesn't go through, we're probably going to drop down from 27 back down to 20, maybe a bit higher because someone else might come out and have a bid, but you get the point. They're going to lose immediately a set amount and they'll work out that risk to reward and then calculate it based on the probability that they believe of the deal going through, and they'll say, okay, you know what, it's a good buy. On the flip side, they may say, you know what, there's no chance, there's an absolutely zero chance that John's Metals will take £27. They've just been spending loads of money on business plans for the next 25 years. They've done this, they've done that, they've done the other. You know, they're looking to kind of build their earnings per share up. They should be valued more like $100 a share in 10 years time, if whatever. You get the point. I could go on with all these sort of hypothetical stories, but they might say, you know what, there's no way that's going to go through. Absolutely zero way it's going to go through. So we'll short it at 27, and our risk is obviously $3 if it does go through. And if it doesn't go through, we're going to make our $7 or wherever it falls back down to. But it's going to obviously fall down immediately as soon as the deal falls through. So there's those two kind of ways of looking at it. Generally, it's the former, i.e. people are buying because they perceive that it's definitely going to go through and they think the market's undervalued it. But it could be the latter if they've got some sort of information to believe that, and obviously the risk is a little bit more capped on that. The other way that these mergers, and I've simplified this, guys, and I've really kind of done a broad overview of it. And if you've got, you know, your comments, obviously in the comment section below. One more thing these guys do is, you know, if they're buying, it's like an activist type hedge fund where they will buy a bunch of stock, buy a bunch of shares so that they've got a lot of voting power, then they can do either one of two things. And if they've got that bit more control over whether these mergers go through, they can say, well, yes, actually, we want to push it through, and we've got X% of the votes because we've got quite a large holding, and they become kind of activists and make a decision or enforce their decision because of the majority shareholding they've got. Or they say, you know what, we want more for this, so we're going to say no because we think this thing's worth £40 a share, or 35 or whatever. So, you know, if they happen to be a large shareholder, then this becomes a little bit more of a kind of active strategy for them, because they get a bit more of a say in what happens, and they've got a bit more of clout and maneuver and things based on what's happening with the voting and what have you. But if they're not, and they're just literally buying shares, it purely becomes a play of, hey, do I believe that it's going to go through? What are the chances of it going to go through? Is this undervalued compared to the chances? What's my risk on it? What's my reward? Do the calculation. Yeah, it's worth putting £1 billion into, whatever it may be. Anyway, guys, that's the kind of basics of merger arbitrage. If you like the video, give it a thumbs up. Don't forget to subscribe for more videos from me and other traders on this channel. Take care. Bye-bye.